Welcome back, everybody, to Mondays.
Whoa, you stole my intro,
I
dude.
always steal your intro, man.
Killing me. You're killing me.
The thunder's on this side of the table, all right?
Ooh. What did we do this last weekend, man?
Oh, what did we do? We did a property tour. That's what we did.
Oh, was that it?
That's all we did. We had a big conference. It went awesome. You know, huge turnout.
Multifamily Investor Network. It was
750
badass.
people.
Yes.
Packed house. And, you know, people had a good time. So looking forward to the next one. Where are we doing the next one, Ben?
San Francisco, August 5th.
That's
so
right.
we might even have a slide in this one today. We will see. This is going to be the rock bottom, best pricing that you can get. Obviously, Bay Area in August. It's going to be nice, beautiful. We'll have a bunch of great panels, a bunch of great presentations, and ultimately an awesome opportunity to network. I mean, I literally talked to, I no joke, probably 200 or 300 people this weekend.
That's right.
It was crazy. Like, you get like 5 steps, and then there'd be another person that you haven't seen in a while, or somebody that wanted to come up and talk to us, or whatever it might have been. It was great. So really, really excited to have the next one. You know, and anybody that did attend, we'll be sending out those Ignite presentations that were really, really popular coming up here in kind of a wrap-up email.
So, like we tell everybody, it's all about networking. The deals get done outside the room, getting out there, talking to people. You never know who you're going to run into.
No, that's the most valuable. I would say that's the most valuable part, right? 100%. You'll get some golden nuggets, and you know, obviously we were up there doing some presentation. You'll get some data from that too, right? But at the end of the day, you know, it's the connections that you make that are probably the most valuable part of these things, right? Absolutely. So, what are we talking about today, though? We're back at it, Mondays.
Deals, and location.
So, what is it? What do they say about real estate? It's all about
the location.
It's all about the location,
and you make your money on the buy, not the sell. That's the two probably biggest things they say about real estate.
And I would say both are very, very true. Very true. You know, I mean, again, folks, yes, you can make money in a tertiary or secondary market or something. I mean, you know, we were talking about, you know, I always pick on Topeka or Detroit, but people are making money on real estate in Topeka and Detroit. It just all depends on what part of that market you're in. But we tend to try to stick to primary markets, you know, in the Sunbelt states. So just to give you some perspective on what our buy box is. So what does that mean? That means Houston, that means DFW, that means Austin, San Antonio, and then obviously Atlanta, and then Jacksonville, Orlando, and Tampa in Florida, right? We're also looking in Tennessee and a couple other spots. The reason that we're going there is because you have all good economic data coming out of these places, folks. People aren't moving to New York. They're not moving to California, right? These people are moving away from there en masse to these other spots because at the end of the day, there's more job opportunities. There's a cheaper cost of living. There's great education down here. You know, just ultimately more opportunities to thrive. Not just live, but thrive, right? And that is going to drive demand for rental units.
Absolutely.
Which is ultimately going to help us push rents, folks.
And as an operator, our job is to make our job easier by reducing risk, and picking deals in better locations helps make our job easier. Not to say, like Ben said, not to say a bad location is not a deal, right? But you have to be comfortable with the amount of work, the amount of risk that adds on to the project.
And we talked about a couple times this weekend, risk-adjusted, folks.
Yeah, so, risk-adjusted returns, your RAR.
Yes, you're. I like that. RAR. All right, I'm gonna have to steal that one.
Absolutely.
You know? But bottom line, why are we even bringing that up? It's because, hey, yeah, you might get 10% cash on cash in Topeka, but your cap rate's probably going to be an 8 or a 9, right? And so you're thinking, oh, I'm getting a great deal. Well, guess what? On the back end, you're probably still selling it at an 8 or 9 cap too, right? Whereas there's other markets that the cap rate might compress. Therefore, you're going to get some more market appreciation growth there, right? But would you invest in every part of Houston?
The right price.
Well, okay. But all things aside,
generally, I like to make my job easier, right? As an operator, there's areas of Houston that I think we're just done with, right? Like, yes, if it's a steal of a deal, we'll do it. But generally, we'd rather pay a little more for a better location than pay a little less for a worse location.
Yeah.
Is that right?
Is that right?
Yeah, I'd rather pay a little bit more for a better location versus stay where you are. Maybe not less, but yeah. But you know, because it just, again, there's risk.
Doesn't mean pay up, folks. It just means like all things created equal. A 1970s deal in Pasadena is way different than a 1970s deal in the Woodlands here in Houston, right? For those that know Houston, right? They're just different markets, right? Again, it all is based on what is happening in those areas, right? You know, so even within these Sunbelt locations, we're also looking at the different pockets too.
Absolutely, and that's where you got to know your submarkets, know your areas, because some submarkets are growing, lots of transition happening there. Doing rent pushes is easier, better client base, less crime, all of these things, right? It's all about, the location.
You have some wind at your sails.
A 70s deal in Pasadena probably has risk of crime. 70s deal in Woodlands, probably not as likely to have crime.
Yeah.
Right? And so,
well, what are some of the other things that we kind of look at too?
I mean, in terms, you said outside location?
No, well, location is, but some of the other metrics, right? Like school district.
Yeah, I mean, a school district, we look at just what jobs are around, right? What's accessible from there? Because sometimes, you can get an okay area if everything else is accessible. We have a deal on the northeast side of town, which area's okay, but there's a lot going on in the general area. You can quickly get around town, and it's one of our better deals. And so, again, location. It doesn't mean the immediate submarket, but it means the schools. It means the tax in the county, right? There's a deal we were looking at today where it's just by being a little bit north or a little bit west, you get into a different county and you're a different tax profile, which makes it
which is a huge difference. And like
my house that I moved into, I was looking at 2 neighborhoods. One of those neighborhoods is 3.4% tax rate. My current neighborhood is 2.3%.
That's real purchase. That's real purchasing power.
That's a huge amount. It's a 30%, almost 25% difference in taxes.
Yeah,
that makes a big difference. And that was part of my real estate motivation of choosing the neighborhood that I'm in, because that's real cost.
So your millage rate, folks, right, which is what Ferris was just talking about, your tax rate, the school district that you're in. We talked about crime. Obviously, you always need to look at crime. Right? Are you close to the path of progress too, right? Like, our Northeast Houston deal is kind of on the cusp, but there's things that are happening north of it and south of it, and what's happening is they're converging on our property. So it's nice to kind of get ahead of that, right? Because then you could sell into that growth, right? Or are you adjacent to some new development or some new redevelopment? We're always looking for those things, right? The Woodlands our property is 5 minutes away from the Exxon and the HP global headquarters. Right? Yes, not all of our tenants are going to be living at or going and working there, but there's service industry jobs that support those global headquarters. That's what you're talking about, right?
Absolutely.
So again, that all drives, even within these bigger markets, what pockets within those bigger markets are you looking at, right? All right. So we had some questions that had kind of come in before the show. So how do demographic trends and local economy affect returns on multifamily investment? I mean, ultimately, hugely. Yeah. Right?
The economy is what pays the rent.
Yes.
You want to be in a good economy. Like the energy corridor. Why is the energy corridor as great of rents as it is? Because you have a lot of engineers in this area.
You have affluent people that have expendable money. And I would also say, even to you, you have a lot of people that are in the energy business. They might be expats living here. They might not want to buy a single family home because they're only going to be here for a couple years, right? Mm-hmm. But those people are making $200,000-$300,000, right? So they can afford $3,000-$4,000 rents.
We almost bought a townhome deal just down the road from us that had 300. I don't remember, over $300,000 a door. Maybe it was somewhere close to $300,000.
But it had $4,000 rents, though, folks. So my point is that. Following, that's more of a white collar, job type play, right? Whereas this might not necessarily work in other pockets, but even that local economy is going to drive some trends. And ultimately, if you can play into that, find the right asset that is going to be in demand within that pocket, you're gold, right? So let me give you another example too, right? We have a property called Estates at Cypress. It's out in Cypress. It's close to where I grew up. Right, I knew that area very, very well, but the one reason that I really, really liked it is it's right across the street from a school. And we have a bunch of townhome units, we have a bunch of 3-bedroom units, right? Well, who's all living at our property? Families.
Yes.
Because all of their kids go to school right there, right? And so if you play into that, you might it makes your life a lot easier, right? Don't go against the grain.
Yeah. One interesting, we did get a big discount on it because Ben did live in the area previously, so we were able to, negotiate that discount.
A little bit.
But again, we like family deals. Guess what?
We love family deals.
Families have more stuff, right? It's like storage. That becomes more effort to move, right? If they're happy, they enjoy where they are, they're in the schools that they're comfortable with, why move? So.
Yeah, no, I mean, I would say bottom line is the school, right? Like if your kid starts in kindergarten at that elementary school, guess what? And you probably have kids behind him or maybe in front of them, right? You're not going to move unless there's just some gigantic, like life-changing thing that's going to force you to move. You're going to stay, right? And the more likelihood that they stay, the less likelihood you're going to have in turnover that you're going to have to deal with, right? Because turnover, every time someone moves out, you got to do carpets, you got to do paint, you got to do some upgraded on the fixtures. It's going to cost you at least $5,000, right? Whereas if those people are going to stay in that same unit for 5 years, boom, You're saving 5 times 5 is 25 grand right there. And they're taking rent increases each year. Right, but again, you have to look at the market and what's happening there and make sure. Now, the flip side of that, if that deal was all 1 bedrooms and you're right next to a school, you'd be like, okay, this is kind of weird. Why would you have a bunch of 1 bedrooms next to an elementary school, right? All right, moving along. How does competition in a particular market impact the returns? Actually, that's a good question.
I mean, there's actually the deal on the Northeast side. Not a lot of competition.
No.
We push rent significantly, right? But we have other deals that are in apartment-heavy areas, and it gets harder, right?
It does get harder.
That's where you look for deals where people are selling, and that means people are going to come into fresh capital and continue to push rents. And so definitely be leery.
Actually, I like that point. Let's drive that home. So that point's important, right? When you see a lot of things trading in a certain area, you'd say, oh, well, why is there a reason that they're all selling? Is that a bad thing? I'd actually say it's a good thing.
Yeah.
Because those people are coming in with fresh money. They have to hit their returns. So what are they going to do, folks? They're going to put money into the deal, therefore improving the asset and the demographic, and therefore the rents are going up. All ships rise with the tide, right? So I think that's an important thing. I would also, this question also, I would interpret it a little bit differently. Competition in my book is how many people are buying and selling deals too, right? I mean, if you're in a particular market that's not as hot, you could particularly, you could get a little bit better of a deal, right?
No, absolutely.
At least on a cap basis.
Yeah. To me, but I think maybe my favorite example is just one of the worst parts of Houston, Greenspoint. There's a tremendous amount of product in that area. And so even if you want to improve it, you got to go buy 30 deals just to be able to control enough to make it better. And that's ultimately the complicated part of Greenspoint. There's just too much housing went into too much of an area, and it went backwards, and nobody kind of got ahead of that. So it's something to think about in terms of where you buy. The number of deals around you, there's pros and cons. And, again, I like to be the guy with, basically where you have that control because you have more products or better products. So
I mean, like people are always like, oh, it's kind of on an apartment row. Is that a good or a bad thing? And there's pros and cons, right? But I'd say ultimately there's more pros than cons in being on apartment row, right? Because if you were the lone apartment on some real random side street, you might even be in a great part of town, right? But people don't drive by you and they don't see that property, you're always going to have problems, right? So even looking at where am I going to buy, it's important to understand that maybe the reason that you're getting a good deal on that is because it's on a side street and they can't get anybody to rent from there, right? Or they have to always give concessions just to get people in the door, right? And so you got to take all of that stuff into consideration. So don't just look at the numbers, folks. People tend to get caught up on these caps and stuff like that, and they have to take a step back and look at it holistically. Why are you getting a good deal on that? Right? Because the one consensus that we got over the last 72 hours with our conference and the 750 people that attended is that there is still a ton of demand for this stuff and there is a ton of money looking for these things. Now, everybody's being cautious and everybody wants to buy the right deal, but multifamily ain't going away. In fact, it's getting more and more popular.
Absolutely.
So you have to be more and more strategic on what you're going to go and buy, right? All right. So why is proximity to amenities important in driving returns? Right. Again, I think amenities in the way that I'm interpreting this question is like, are you close to a grocery store? Are you close to restaurants and shops? I'd say that's a tremendous, huge thing that we love to see. We call it the Starbucks effect. Right? If Starbucks is within a half mile or a mile of our property, we're interested, right? Not only because they're going to be doing the demographic work to determine can people afford $6 lattes, but it just means it's a more affluent and growing area. Starbucks is not going to put Starbucks in places where people can't afford those, right? But it's also nice to have that when you're getting prospective tenants in, saying, hey, you got Starbucks over here, you got an H-E-B over here, you've got this restaurant, that restaurant.
There's a couple of the businesses that you look for that help you understand, because those businesses do a lot of homework to determine if an area is worth them investing in, right? Starbucks is one of them. Chipotle is another one. H-E-B, your retailers.
Whole Foods.
Whole Foods. I mean, any of those places, clearly, they think people can absorb the $3 coffee. Like Ben over here, bougie. $3 coffee is right there. It's right in front of you, right?
Well, you got to make sure that because you already drank yours.
I'm not bougie like you, Ben. So something to think about. And, again, it helps make your job easier.
All right, last but not least, so what are some of the potential risks associated with investing in areas with lower demand or weaker economic conditions? I mean, again, folks, I would say if you want to invest in Detroit, be very, very careful because a lot of the economic data isn't going in its favor, right? Doesn't mean that you can't make money in real estate in Detroit. We know people that have, right? But the point is that I would much rather make it's already tough enough operating these properties and getting a good return, right? Why make that even more difficult by investing in a market that's slow or deteriorating, right? Why not have that wind at your sails? That's going to allow that market appreciation to, help kind of push things along, right? Because it's going to grow rents, which is therefore going to grow the valuation. That's why we invest in the Sun Belt. Bottom line, it is the best part of the country to be investing in right now.
100%.
Yep.
So that said, Mondays, if you have questions, comments, thoughts, please leave them. We'll answer them live. Let's see, first one we got from one of our YouTube viewers. Can you tell me how y'all would go about managing your first 40-unit deal? So if you're going to self-manage it, right? So typically we like to say you want to be, 80 units and up, just so you can have full-time staff, and you can use third-party management if you don't have a management company. But it sounds like this is probably about self-managing.
Yeah,
so
I would assume that's probably the question.
if I had 40 units, I definitely would figure out a good part-time maintenance person that I could lean on, and probably a good leasing. So still needs staff. But it's really, again, go use software. Track the units and run it like a business. Don't be the guy that has leases on paper.
Yes.
Follow the process, because again, if you have a formal lease, that means you can do an eviction. If you don't have a lease, it's a lot harder to do evictions. It's a lot harder to track things, a lot harder to collect rents and know people are late, etc. There's a lot of other simpler software. So we use RealPage. RealPage is complicated. There's a lot in there, but if you're doing a small 40 unit, probably like a Buildium is a good example, right? You just want
I was going to say ResMen maybe too.
Maybe
ResMen might be a middle tier, but yeah, I would agree with Ferris. You have to automate and make it as efficient as you possibly can. Otherwise, you will be
and you get, and you start to attract the better tenant, right? The person that pays online because you have an online portal, the person that will clear a background check because you're doing background checks, right?
You don't want some, part-time lady going around and collecting money or money orders from people. You want everybody to pay online if you possibly can, right? You want to force that, and I think that's across our industry is what the norm is becoming, because there's been so much fraud and theft over the last 20 years of people trying to scam, people with cash and stuff like that. So I agree. Get your software in place. Don't underestimate the fact that you might still have to have at least a part-time person to help you with that property too.
Absolutely. Let's keep going. Sam Newell says, "Good to see you guys. Great event. Thanks Sam.
Buddy. And I think there's a follow-up there too. I think you need, so reach out to us, buddy. We want to keep in touch.
Yeah, absolutely, man. Thanks for coming out. Eric Upchurch, long time no see, man. Where have you been?
What's up, buddy?
He says, "Hey, look at these fellas. What's up?
What's going on, man? We missed you this weekend."
Absolutely. Anybody else have comments, questions, thoughts? Go ahead and ask them. Otherwise, we'll keep going.
All right. Well, again, bottom line, location, location, location. That's not just a cliche, folks. That's actual reality. All right. So we just talked about it earlier. It's coming up in August 5th?
August 5th coming up in
next
4 months?
Yeah, well, 4
6 months.
Yeah,
6 months.
Yeah, 6 months away. So San Francisco, technically Redwood. I think what you said, it was 12 minutes from SFO.
It's San Jose, isn't it? Redwood.
So out of SFO. But go ahead, check it out. www.mfinvestornetwork.com/SanFran. Go ahead and get your $200 off when you pre-register right now. It runs until February 24th. So that's coming up. I think that's next week or the week after. So it's not too many days away, right? But this is going to be the best pricing that you can get, folks. We'll probably have 500 people out there. Great event, great speakers, great panels. So if you didn't check it out in Houston, or even if you did, we'd love to see you back out there.
Absolutely.
All right. So then we are also doing, I cannot believe this is coming up this quick, March 2nd, we are doing our next meetup, Developing Your Brand in Real Estate. Ooh, that one's going to be good. So it's big. Why are we doing some of the stuff that we do? We're developing our brand, folks. It's all about marketing, right? So March 2nd, right here in Houston. So if you're in Houston, you watch our show, we'd love to see you at Wakefield Crowbar, 7 p.m. It's a Thursday. So come out and check it out. Register for free, disruptequity.com/HTX meetup. That's a free event. We love having people come out, just networking and just hanging out. So, what is coming up next, my friend?
Before you do that, a couple more comments, questions. First one, what's the best management company for 80 unit in Houston?
Oh, man.
We do third-party management, Disrupt management. Typically focus on larger items. You have to kind of do some research around. I don't know a good one that likes to do, that's kind of a rock star at the smaller stuff. you'll definitely want to ask around, and we're probably not the right guys to ask because most of our experience is about larger units.
Well, and I'd say, it's like asking for a referral on a general contractor. I have one person's name in mind, but I don't even want to say who it is because if you have a bad experience, then that's going to look bad on me, right? But again, when it comes to property management companies, ask around, ask for referrals, go out and look at their other properties and see how they're run. It's very, very important. Right now, third-party property management companies are doing a horrible job. That's why we started our own. Right.
Let's keep going. Would love to know your top 3 systems you've implemented to achieve operational success.
I mean, I think it's definitely about reporting, right? RealPage is, has a huge, kind of dashboard that we leverage and we have reports come out of that, right? You need to be checking and verifying all that data.
Asana is another one.
Yeah.
Teams is another one, right? Using Teams efficiently, effectively.
Yeah.
Those are some of the big ones that every company should have. And I'd also add to that too, just fairly strong accounting, right? That's so critical to most businesses.
I mean, because again, your reports are only good as good as the data goes in, right? Good data in, good data out, right? So it's important to make sure that the stuff that's getting put into RealPage or whatever software you have is good. But Teams, which is a Microsoft product, and Asana, we're using that. Those are extremely important in any business to be having. So those should be part of your toolkit in any business.
Awesome.
All
With
right.
that said,
what else are we doing next week, man?
We are going to talk about unlocking the secrets of the real estate market. Navigate and time your investments for maximum returns.
Ooh, all right. That should be fun. So check it out next week, 3:30-ish, right here on Monday Mondays.
See you guys next week. Thank you.